Every boardroom has a guardian of financial truth, a Euros. The Audit Committee. It is the single most important committee in corporate governance. But what exactly does an Audit Committee do? And why was it created? The Audit Committee was born from a crisis of trust. High-profile corporate failures in the late 20th century exposed a dangerous gap between management and the board. Regulators worldwide realized that independent oversight of financial reporting was no longer optional, a Euros. It was essential. And so the modern Audit Committee was born, a Euro, a subset of the board, composed primarily of independent directors, tasked with one mission: protecting the integrity of financial reporting. In India, this is codified under Section 177 of the Companies Act 2013 and Regulation 18 of the CB listing obligations and disclosure requirements. But laws alone do not make an audit committee effective, a Euros. People do. Let us begin with the foundation. What exactly does the law require? Section 177 mandates that every listed company and every public company with a paid-up capital exceeding 10 crore rupees must constitute an audit committee. The committee must have a minimum of 3 directors, with the majority being independent, and the chairperson, a Euros, who must be an independent director, a Euros, must be able to read and understand financial statements. This is not a ceremonial role, a Euros. It demands genuine financial literacy and professional skepticism. The CB LODAR goes for a Euro. It requires that at least 2/3 of the audit committee members are independent directors. All members must be financially literate. And at least one member must have expertise in financial management, accounting, or auditing. The committee must meet at least 4 times a year, with a gap of no more than 120 days between meetings. These are the structural bones, a Euros. But what is the beating heart of the Audit Committee's work? The primary responsibility of the Audit Committee is oversight of financial reporting. This means reviewing the quarterly and annual financial statements before they go to the board for approval. The committee must satisfy itself that the financial statements present a true and fair view. It is not enough to accept management's representations at face value, a Euros. The committee must probe, question, and challenge. The committee reviews the significant accounting policies, judgments, and estimates that management has applied. Revenue recognition, impairment testing, provisions, and contingent liabilities, a Euros. These are areas where aggressive assumptions can mask the truth. The Audit Committee must ask, are the assumptions reasonable? Do the estimates reflect economic reality? Beyond the financial statements themselves, the Audit Committee has a crucial role in overseeing internal financial controls. Under Section 134 of the Companies Act, the Director's Responsibility Statement must confirm the adequacy and operating effectiveness of internal financial controls. This is not just a compliance checkbox, a Euros. It is a statement the entire board signs its name to, and the Audit Committee is the first line of assurance. A critical tool in the Audit Committee's kit is the management letter from the statutory auditors. The management letter contains the auditor's observations on internal control weaknesses, process gaps, and areas needing management attention. And it is the Audit Committee's job to ensure every observation is tracked, escalated, and remediated. The Audit Committee also has a defined role in the oversight of related party transactions. Any transaction with a related party that is not at arm's length or is material requires prior approval of the Audit Committee. This is a powerful gatekeeping function, a Euro, It ensures that assets of the company are not siphoned away through cleverly structured insider deals. Now let us turn to an area where the Audit Committee's role has expanded dramatically in recent years: risk management. The Audit Committee is the board's eyes and ears on the risk management framework. While some companies have a standalone risk management committee, the Audit Committee is the default oversight body for enterprise risk in most Indian companies. The committee must review the company's risk management policy and ensure that the framework is robust, dynamic, and actually used euros, not a document gathering dust on a shelf. Cybersecurity risk, in particular, has become a top-tier concern for audit committees. The committee must ask management, what is our exposure? Have we been tested? What is our incident response plan? The relationship between the Audit Committee and the statutory auditors is one of the most delicate and important in corporate governance. The committee is responsible for appointing the statutory auditors, fixing their remuneration, and reviewing their independence and performance. The committee must have at least one private meeting with the statutory auditors euros, without management in the room euros, at least once a year. This private session is where the real picture often emerges. Euro auditors speak more freely when management is not present. In India, the National Financial Reporting Authority, NFRA, has added a new dimension of regulatory oversight over auditors and audit quality. NFRA can inspect audit firms, review audit files, and impose sanctions euros, and the Audit Committee must be aware of any NFRA findings related to the company's auditors. One of the most vital but often overlooked duties of the Audit Committee is oversight of the vigil mechanism and whistleblower policy. The committee must ensure that every whistleblower complaint is investigated, that the complainant is protected from retaliation, and that the board is informed. The Audit Committee also has a direct role in fraud detection and reporting. Under the Companies Act, if a fraud exceeding 1 crore rupees is detected, the auditor must report it to the central government euros, and the Audit Committee must be in the loop. The Audit Committee is also the primary interface for the internal audit function. The committee approves the internal audit charter, reviews the annual internal audit plan, and monitors the findings and corrective actions. Another crucial dimension, the Audit Committee must oversee the company's compliance with legal and regulatory requirements. The committee should receive a quarterly compliance report from the company secretary or the chief compliance officer. Now let us look at the Audit Committee in action euros, inside the boardroom, when the real work happens. An effective Audit Committee meeting is not a parade of presentations euros. It is a forum for genuine inquiry and debate. The chairperson sets the tone euros. If the chair accepts management's answers without pushback, the entire committee dynamic follows that lead. A weak Audit Committee chair is a governance risk in itself. The committee must maintain detailed minutes that capture not just decisions, but the deliberations and dissents. In the unfortunate event of litigation or regulatory inquiry, the minutes are the committee's primary defense. Good minutes show that the committee applied its mind, not just its signature. Now let us consider the Audit Committee's expanding mandate in ESG, Euro, environmental, social, and governance reporting. SEBI now requires BRSR core assurance for the top 1,000 listed companies, euros, and audit committees must oversee the reliability of this non-financial data. This is a paradigm shift. Euro audit committees must now build competence in sustainability assurance alongside financial expertise. Let us look at the global landscape euros. How do audit committees function in other major jurisdictions? And what can India learn? In the United States, the Sarbanes-Oxley Act of 2002 created one of the world's most rigorous audit committee frameworks after the Enron and WorldCom scandals. The UK Corporate Governance Code emphasizes the audit committee's role in ensuring the integrity of the annual report and accounts, including the fairness, balance, and understandability of narrative reporting. Singapore's framework requires the audit committee to explicitly review the independence of the external auditors annually, euros. A practice many Indian boards could strengthen. The European Union's audit regulation mandates audit firm rotation. Here's regulation every 10 years euro, designed to prevent the complacency that can develop in long-standing audit relationships. India has similar provisions, euros, joint auditors for large companies, partner rotation, and cooling off periods, euros. But the effectiveness depends on how vigilantly the audit committee enforces them. Let us now address the practical challenges that audit committees face day to day. The first challenge is information asymmetry. Euros management always knows more about the business than the committee ever can. The committee cannot run the business euro, so it must learn to ask the right questions and read between the lines. The second challenge is time. Euro. Non-executive directors typically spend only a few days a year on companies' matters, yet they are expected to exercise oversight over complex financial systems. The solution is not more meetings euros. It is better preparation, sharper questions, and a relentless focus on materiality. The third challenge is management dominance, euros. In many boardrooms, strong CEOs or CFOs can unintentionally or intentionally steer the committee away from uncomfortable topics. The antidote is a culture of psychological safety euros, where committee members, auditors, and even junior finance staff can speak up without fear. The fourth challenge is technical complexity, euros. Modern financial instruments, deferred tax accounting, hedge effectiveness testing, consolidation of special purpose vehicles. The committee does not need to be able to perform the calculations euros, but it must know enough to recognize when an answer does not make sense. Continuous education is not optional euros. It is a survival skill for audit committee members. Let us now look at the future euros. What will the Audit Committee of 2030 look like? Artificial intelligence will transform audit committee work euro. AI tools will analyze entire general ledgers, flag anomalies, and generate risk alerts in real time. But AI will not replace judgment euros, it will amplify it. And the audit committee must ensure that algorithms are governed, not blindly trusted. Climate risk is another frontier euro. The audit committee must now oversee how climate scenarios affect asset valuations, impairment testing, and going concern assessments. The audit committee must also engage more deeply with technology governance, euros. Cybersecurity is no longer just an IT issue. It is a board-level financial risk. Now, let us bring this all together euros. What makes a truly great audit committee? A great audit committee starts with the right people euro, independent in mind, not just on paper. It requires financial literacy that goes beyond reading a balance sheet euros. It requires the ability to interrogate the assumptions behind the numbers. It demands courage, euro. The courage to ask the uncomfortable question, to challenge a powerful CEO, to say no when everyone else is nodding. It requires diligence, euro. Reading every page of the board pack, not just the executive summary, because the devil is always in the footnote. And above all, it requires integrity A euros. The quiet, unshakable commitment to do the right thing, even when no one is watching. These 5 qualities, AA euros, independence, literacy, courage, diligence, and integrity A euros, are not items on a checklist. They are the foundation of effective audit oversight. For aspiring independent directors, serving on an audit committee is the most demanding A euros and the most rewarding A euros boardroom role. For companies, a strong audit committee is not a cost of compliance A euros. It is an investment in trust. And trust is the ultimate competitive advantage. For India, building a cadre of world-class audit committee members is essential to attracting global capital and deepening our capital markets. The audit committee is not the policeman of the boardroom A euro. It is the conscience. Every financial statement that reaches the public, every audit report that is signed, every whistleblower who is heard A euros. Behind each of these is an audit committee that chose to do its job with seriousness and integrity. And behind each great audit committee is a chairperson who understood that the role is not about power A euros. It is about responsibility. To every independent director watching, to every company secretary preparing the board pack, to every auditor walking into that private session A euros, the audit committee matters. It is the quiet bulwark that protects the integrity of our financial system A euros. One meeting, one question, one decision at a time.